welcome to the Possible Promise Podcast. Every Monday, Wednesday, and Friday, we go live at 12 p.m. Eastern to break down the complexities of finance and point the way to financial success. Today is July 1st, 2020, and I am your host, Brandon Oliveris.
And I am his wonderful wife, Christine.
This is episode 9, Manage Your Position Sizes for More Consistent Gains. Welcome everyone to the podcast. I'm sorry if you are live or a couple minutes late. It was kind of a hectic morning. There's a lot going on today.
Well, Brandon decided to undergo a project right before the podcast.
Yeah.
He does not have very good time management skills.
We're getting a new bed today, and we got the frame. It's been like 4 weeks since we ordered the bed. They've been really backed up.
We got the frame like a week ago, mind you. 2 weeks ago.
Yeah, 2 weeks ago. And so we're getting the bed today. Someone's going to help us put everything together later because like the frame's huge. And I thought maybe I can get it upstairs, but I couldn't. And that was at
11:30.
11:30. That didn't work.
And I didn't eat lunch.
You did eat lunch.
No, I hadn't eaten lunch.
Oh, I was going to say, you did eat lunch.
Just ate 2 peanut butter and jelly sandwiches.
Yes, so we're a couple minutes late. But
I'll give him that he's stubborn. That's good. Just as stubborn as me. Maybe more so.
So, today is July 1st, the beginning of the new quarter. Yesterday was the end of the second quarter of the year, and it saw the market. It was a crazy quarter for the market. I think for the S&P, it was the best quarter since 1998, I think is what I saw. Oh,
wow. Really?
And so in the first quarter of the year, the market fell pretty much exactly 20%. And in the second quarter, it gained 19.95%. So, that happened.
The third quarter now?
Now this is the beginning of the third quarter.
Okay. So the first quarter starts in
January to
okay,
March, and then April to June, and now we're in the third quarter.
Okay, cool.
And the market was crazy yesterday. Went up like 1.5% for the S&P, and back up to about 3,100. And today is largely positive, I believe. I haven't checked for a while, so we'll see in a minute. But it's been the best quarter since 1998, and there are a whole bunch of other statistics. The NASDAQ, I think it was the best since 1999. The Dow, I don't remember, I think in 30 years or something.
I was a kid back then.
Yeah.
I was 8. And
so was I.
Yeah.
To be fair.
Well, but
so were a lot of people. I mean,
I know, but it's just, it puts, I don't know, it's just weird. I don't like it. I'm 30 and I'm sorry. I'm having a midlife crisis for a minute.
This is kind of an unprecedented year with all this stuff happening, and the market apparently thinks that we're back to where we were at the end of last year. So,
because it's a new quarter, I bet.
Well, just in general, that the market is pretty much where it was at the beginning of the year almost.
I didn't realize it was doing that well.
Yeah, it's been crazy. It's still very volatile. Volatility is still over double what it was at the beginning of the year. You didn't know this, Christine, because I didn't talk about it, but at the beginning of the year, the VIX was down below 15.
Are you kidding me?
And now it's like over 30. Let's see what it's at today. It actually just came below 30 today, so that's pretty big. But, it's double what it was in January, so, that's... you don't see the whole story unless you take that into consideration, but it's just crazy. So over the last 6 months, it's like not much has happened, even though a ton has happened in a sense.
Right. So, it's so weird.
So the S&P today is... Oh, that was the VIX. Let me get back up to the top. Yeah, we're up about 12 handles from where we were yesterday. Because I remember it was right about 3,100 we ended the day. So up about 38 basis points, down I think from the highs, because I think we were up quite a bit more. Let me see what the high of the day was, because that is not what I wanted to say. We are up almost like 0.7% earlier. So let's see now.
You mean this morning?
This morning, yeah, earlier. The high was 31.22. So
oh wow,
we're down from that, but still up. And the Dow is still working on 26,000. We lost that a little while ago, but up a whole measly 7 points. Barely anything, 3 basis points. And the NASDAQ is actually up 88 points. Also 88 basis points. That likes to line up really well.
Yeah.
And the VIX, like I said, is down about almost 4%.
Oh, wow.
So, as I predicted Monday, I said I thought volatility would fall. And it has been all week. So that's been working out. Now,
You're a genius.
No, it's just, I don't know. It was... the futures were really negative. I mean, the futures, when I looked last night before bed, they were down, I think, to about 30.60 or so. They were down quite a bit. And so everyone kind of thought we were going to have a red day today. But then some things came out. Basically, Pfizer. Have you heard of them? Pfizer?
Yes, but I don't know what it is.
Drug company.
Okay.
They've had positive results with a potential vaccine.
Oh, that's why.
Yeah, so...
they still have? That's good.
Well, that was just reported today. So they've been seeing positive results.
So maybe it'll actually roll out soon?
I have no idea. I just know that much, that there were positive effects of the vaccine, so that's optimistic, and obviously the market's jumping on that.
Of course it is.
And then we also had the payrolls report this morning, which I wrote down what it was because I don't remember. Okay, so the employment change, we had 2.37 million new jobs versus an estimated 2.9 million.
Oh, wow, so we're low.
It's a little lower, but still, I mean, a creation of jobs instead of losing them like we were.
That's true.
All through like the last several months.
Right. Yeah.
So that's good news. So yeah, I mean, everything's pretty positive today, and so the market likes that. And and again, it's a shortened week. Who knows where we'll be tomorrow?
That's right, because Friday.
Yeah, Friday is off.
Are we still having a podcast, even though, yes, for Friday?
I haven't thought about that. I have no idea yet.
Because you can't...
I don't know. I mean, we could do it Thursday, since that's sort of Friday. We'll have to talk about that.
Or just do something and not talk about the market?
I don't know. We'll have to see.
I'm sorry, I shouldn't have asked you.
No, I'll decide by the end of this show so we can tell everyone. I really have no idea.
I'm sorry.
I no, it's good because I didn't think about it. And
I mean, because usually people do podcasts in line with the market, so
yeah. Well, I know with Tasty Trade when the market's closed or something, they either postpone or push it back, or to the day when it's actually open. So
right.
We'll see. I don't know yet.
Okay.
We'll decide by the end of the show.
Okay.
Anyway, so let's get into. Let's see. It's time for Ask Possible Promise. So we will get into that now.
Do we actually have questions?
Yeah. So we do have a question.
Not from me, though.
No, you could ask a question.
I don't know any.
If you wanted to, you could ask a question. I'm gonna
You'll probably be asking. What?
No, I was making sure I didn't have another question, but no, I didn't. Okay. You could ask a question.
Why is the sky blue? No. Ooh, wrong topic.
Yeah, I don't think it's going to work. All right, so someone asked this question. I'm looking to write my first covered calls. Questions. How far do you typically like to go OTM, which is out of the money? And how many DTE, days to expiration, do you choose? I was thinking of selling weeklies on Monday and having them expire on Friday and starting all over the following Monday. Also, any particular ways that you choose the underlying stock that you buy. For example, only blue chips in a certain price range, etc. Thanks in advance. Hope my understanding and questions made sense. All right, so that's the question. So for people who may not know, let me just talk about what the heck a covered call is.
Yeah, really.
So why is that?
That was me. My watch.
So very briefly, if you remember a call, when you sell a call, it gives you the obligation or creates the obligation to sell 100 shares of that stock at the strike price, right? So what people do is if they own 100 shares or some multiple of 100 shares of a stock, you can write a short call on those shares at a higher price. So let's say you own a stock at $100 and then you write a call at 110, and then if the stock, so you receive a premium for that, you receive a credit, and then if the stock reaches 110 or above, then they get what's called called away, which just means you have to sell those shares. You get a sign on it, you sell the shares, but you made a $10 profit per share on the stock because 100 to 110, plus you got the premium from the call that you wrote. So it's kind of an all-around positive thing, you know.
I got lost, like, right when you started.
Okay, so let's try it again. So
I'm sorry.
Okay.
I got, like,
So let's say you own 100 shares of some stock, XYZ, at $100.
Okay.
And you sell a call. When you sell a call, it creates the obligation to sell 100 shares of a stock at the strike price if it's assigned.
Right.
So let's say you sell a call at 110.
Okay.
And at $110.
That's the premium.
The strike.
Strike.
Let's say you sell it for a premium of, I don't know, $4.
Okay.
Okay, just pulling a number out of the air. So let's just say $4. And okay, that's a text message. So you receive, $400 credit because it's 100 shares.
Right. And
then if the stock goes from 100 to 110, now you've gained another $10 because the stock went up.
Right.
And then if, that happens and it gets sold because of the call, you've profited, $10 a share for the stock plus $4 a share for the option, basically $14. And so it's okay. Like, usually we think of assignment as a bad thing, but if you sell a call and your stock gets called away, it means you made a profit.
Right.
So it's a strategy people use because let's say it doesn't reach the call strike, then that expires worthless. You can do it again. You can sell it as long as you want to and keep collecting credit, keep collecting premium and just get more and more money. And then one day the stock will get sold at that price and you've profited. So it's a really nice way to profit off of owning a stock.
I think I sort of got it, kind of.
Okay, you can ask me if there was a part of it you didn't get.
I don't really know.
Okay.
It's too many numbers.
Okay. So, but that's what a covered call is, and it just means you own the underlying stock, and you're writing a short call, and you could get assigned on it, but you own the stock, so it's okay, and it's a way of making money. So This person's asking, let's see, they were asking, what DTE to use, how far out of the money to go, and which stocks to use for that strategy. So covered calls are something I want to do. It's not something I've done too much of, just because I generally just do credit spreads for options.
You'll try it.
I'm going to at some point. It's a really conservative strategy. I mean, you really can't. The only way you can lose is if the stock really falls a lot. But if you're neutral to bullish on a stock and you sell some calls on it that may expire worthless, it's a really good way of making money off of the stock. So as for how far out of the money, I would give the same advice I would give for any kind of short call or put or anything, which would be where the probability of being out of the money is about 70%. So basically, we're going to talk about Delta in a future episode, but Delta is one of the option, they're called Greeks. It's one of the option kind of statistics. And when the delta is around 0.3 is generally where you want to sell a call probably. That gives you about a 70% chance of expiring worthless, which is what you want, and still get a good bit of premium. And so that's what I would do for a covered call. It kind of depends. I mean, the question I would ask myself is, where do I think this could go in the next, however long until the expiration, and then go a bit higher. So if you think it's going to move $10 or $5 or whatever, go a bit higher than that, because ideally what you'd want is for it to be worthless, to expire worthless several times over, so you can keep collecting that premium, and then one day it will get assigned, but you don't want that to happen on the first time usually.
Yeah.
So for days to expiration, that's just how many days until the option expires. Mm-hmm. So weeklies are fine. I mean, I think anything's pretty much fine. The only thing with weeklies is that, you can, in my opinion, you can be a little more at risk of hitting that price because you don't have as much of a cushion. So when you have a monthly expiration, you can go 4 or 5% out usually, out of the money. When you have a weekly expiration, you might only be able to go like 2 or 3%. And so, if you have a big move in the stock, then you might lose it more easily. But I've also seen research that says if you sell weekly, let's say you sell 4 weekly calls, like in a row, week by week by week by week, mm-hmm. versus just selling the monthly, you collect a bit more premium than just the monthly call. So I think there are advantages to both sides. The monthly one is a bit safer, but you might get a little bit less premium for it, whereas the weeklies are a little more risky because you might have a big move in the stock, but you'll collect a bit more premium overall. I think it's about 20% more when you add it all up than just the monthly. So as for which stocks to use, I think really just something that you're neutral to bullish on, something that you think is going to grow over time, something that you're willing to hold for a period of time. So a company that maybe you believe in, you're willing to hold for a period of months, maybe, however long it takes to get assigned on it. So, I mean, I wouldn't get too picky. It just depends on your portfolio size, how big of a stock you're willing to buy. You might not have the portfolio to buy 100 shares of Amazon at, over $2,000.
Oh my God.
Or Apple, at whatever it is now.
It's pretty expensive, isn't it?
Yeah, so I mean, you might want to go with cheaper ones. I wouldn't go too cheap, obviously, but I just think it depends, like, what do you want to own? What do you see kind of going up in the near future that will gain in value and that you can kind of collect some premium on in the meantime? So that would be my thing, like, just something, as long as you're not super bearish on it, as long as you don't think it's going to fall. I wouldn't be too picky about which stocks you choose. So that's my answer to that. I know there are some terms in there that other people maybe haven't heard yet because we haven't covered them, but I'm assuming since this person is asking this question that they kind of know these terms. But yeah, just to summarize, as far as how far out of the money, I would go for a 70% or so probability of being out of the money, of expiring worthless. If you don't have that statistic in your brokerage, then it's about a 0.3 delta. As far as days to expiration, I gave the balance between weekly and monthly. The weekly is a little more risky because you could have a big move that calls your stock away, but you'll collect a bit more premium over time. The monthly is a bit safer, but you'll get a bit less. And as for which stocks, just kind of something you believe in that you think is going to gain in the near future. So that's kind of, and probably something too that isn't going to have a huge gain because, if it's like earnings, for example, and it goes up 7%, that is probably going to get called away unless your short call was super far out of the money. So something that's going to gain, but maybe not too fast. That's kind of what I would say. So that's my answer to that. I know we left probably poor Christine behind
somewhere else
a while ago, but I just want to answer it. We'll cover all these terms in a later episode, but
I'm not worried.
That's what I wanted to cover today. All right, so let's get into our topic. By the way, if you do want to ask a question for the Possible Promise podcast, you can go to possiblepromise.com/ask and ask your question there. So I know some people like to answer multiple questions at a time, but I like to, spend time answering thoroughly. So hopefully that helps. All right, so on to our topic. Manage your position sizes for more consistent gains.
Whatever that means.
Yeah, you're about to find... Did I tell you the topic before?
Yes, but you didn't tell me anything about it, so I'm in the complete dark.
Okay, that's good. So...
Oh, that's good, huh?
Yeah. So,
It's because he's going to quiz me. We know that.
Oh, yeah, at some point, yeah. That has to happen. Hopefully I get the right buttons this time so I don't give the, correct cue when it's the wrong one. That wouldn't be good. So, position sizes, I've talked about the importance of risk management, and we haven't gotten into that too much yet, and I do want to do a series of episodes on risk management, but one of the most important parts of this is your position size. Your position size just means how much capital do you commit to this trade in proportion to your entire portfolio. Okay?
Okay.
Did that make sense?
I think so.
Okay. So how much am I going to... If it's a long position, like something you have to pay money for, how much money am I going to spend on this? Am I going to spend like $500? Am I going to spend $100 on this trade? Or if it's a credit strategy, if it's a short position, how much am I going to have to set aside for it? If it's a credit spread, for example, how much collateral am I going to have to put aside? Whether it's a $300 or $3 wide spread or a $5 wide spread or whatever.
So it's knowing how much to put in each option.
Right. Whereas, if your portfolio is $10,000, then you probably don't want to put down $1,000 on one position.
On one.
Right.
Because you do multiple positions and multiple options.
Right.
And stuff.
So,
okay.
Yeah. So what a lot of people do, especially beginners or people who are just getting into options or... unfortunately into penny stocks or things like that, is they will, and I hate this term when I see it, they'll say, I'm going all in.
Oh, God.
I'm like, no, don't go all in. That's the worst thing you could do.
It's okay. People are stupid.
You don't want to put a significant part of your portfolio. I mean, it's okay to speculate a bit. Just, speculating meaning like it's okay to take risks.
Well, yeah.
I mean, all investing is risk, but it's about risking a little bit at a time so that if you lose, then it won't really matter that much. If you have, a 1% position in your portfolio and it loses, it goes to zero, it's not going to bother you all that much, right? I mean, we all hate losing, but 1% is not really going to cause you to lose any sleep.
Yeah.
Whereas if you have... 50% of your portfolio in one trade, yeah, you're not you're not going to sleep that well, right? I mean, you're going to be watching that like a hawk. You're not going to be able to let it go. You're going to be really emotional. You're going to panic sell if it starts going down. You're not going to make smart decisions. So, for any kind of trade, I don't care if it's stocks, I don't care if it's options, whatever it might be, for any kind of trade, I would not suggest opening a position with more than 2 to 3% of your portfolio. Sometimes, if it's a really high probability trade, you might extend that to 5%, but I would not go any higher than 5%, and that would be an exception.
With any option?
With anything,
stock.
Right.
Okay.
Now, sometimes, and I say when you open it up, because sometimes when you have a stock and it starts to run, it starts to, really gain in price. You have Netflix has done that, Amazon has done that, Apple has done that. You're not going to be able to help. Let's say you put 3% into it and it doubles in price. Well, now it's going to be 6%. What are you going to do? You don't really have a choice, right? But just
you start with that.
You open a position at 3%, 2 or 3% rather, and that's it. Now, so, like I said, a lot of people like to put a lot more, but it's just not that smart. So that means if you have, let's say, a $5,000 portfolio, you're not putting on more than $250. Actually, that's just 5%. So for a $5,000 portfolio, $100 to $150 per trade. Now, a lot of people will say, "Wait a second, that's nothing, right? That seems like nothing. $100, $150, that's like really small. At the most, $250, right? A lot of people like to just plunk down like $1,000 on a single trade and just hope it goes well. And I used to do this, like before this whole crash. Like sometimes I remember my probably biggest risk, and it paid off, thankfully, but it was stupid. Shopify was having earnings.
Oh, that's right. This is way back in the beginning, right?
Yeah, do you remember this? Shopify was having earnings, and I had... Well, first, it went well, because I had a... What did I do? I think I had a credit spread on it. I don't... No, you know what I had? I had a call debit spread. So I had it's a bullish trade, a call debit spread, where I bought one call and sold a higher one. And that was fine. It was, not too big in my portfolio. Probably too big, but not horribly so. Mm-hmm. And Shopify, hit it out of the park. It just jumped right out the gate from the opening of the market that day. It just jumped up. And so, I closed my position. I was really happy. And I thought, it's gone really high. I bet... people are going to take profits. People are going to sell it off a little bit. It had gone up maybe $100 in a day, right? So I thought, what if I put on a put? And I think I literally put $2,000 into this put, and I stayed in maybe 15 minutes. I gained $500 off of that trade, but was that talk about gambling? I mean, that was horrible, right?
But it worked.
It worked, yes.
That's not the one you got assigned on, is it?
No, that
was something else.
Was SPY, and that wasn't my fault. It just
no, I know
happened.
It wasn't. I know.
No, I didn't get assigned on that. I was only in the trade for maybe 15, 30 minutes, and I couldn't take it anymore. I gained $500 on my $2,000, and I'm like, I'm out.
Well, that's really good, though.
So, yeah, I don't have that kind of appetite for risk anymore just because of how unpredictable things are. But
you probably could later, once it's...
Yeah, as things grow, I can. But, I was a little naive, I think.
That's okay.
But I'm like, yeah, I'm going to put on this $2,000 trade and and just see what happens. I mean, it worked, but it didn't feel very good. I was really anxious. It was not the best decision.
Oh, well.
So... that was not great. But a lot of people do this, right? They'll put $1,000, $2,000, $3,000 or more on a single trade when their portfolio can't handle it. Maybe it's only a $10,000 portfolio or even $20,000. They can't handle that size without really stressing over it. Because the thing is, and I've said this before, I've stressed this before, is that you have to be willing to take the loss. Because the loss is a very realistic possibility, right? You could lose, and you could lose everything you put into it, right? So unless you're willing to lose everything you put into that trade, don't do it. And so I would ask myself, and I do ask myself, am I willing to lose this whole position? Now, a lot of times it doesn't come to that, and especially with debit strategies where you pay money to enter, the way I do risk management on those is I don't let myself lose more than 25%, maybe 50% if I really believe in it. So it wouldn't go to zero, but you have to be willing for it to get there, because anything can happen, right? You can have the greatest confidence in a stock and buy a call on it, and the next morning you wake up and some horrible news came out about that stock or about the whole market, and that dropped 75%. You just don't know what's going to happen.
Yeah.
So you have to be willing to lose every penny of what you put into it, whether it's a debit or a credit strategy. And so that's why you want to put, small positions, 2 or 3%, maybe 5% at the most, if it's a really high probability. But you have to really be careful. It's tempting to put on a lot more than that 2 or 3% because we think, well, if I risk 10% and it works, and I make a 50% profit off of it or whatever, then I'll gain like a lot of my portfolio, right? But what if you lose that 10%? Then you'll lose a lot in your portfolio. So people tend to look at this through rose-tinted glasses sometimes, where they only look at the upside, but they don't look at the possible downside.
Yeah.
So unless you're willing to lose every penny of what you put into it, don't do it.
Right.
So, like I said, 2 to 3% is what I recommend. So, in terms of credit strategies for options, that would look like, okay, let's say you have a $10,000 portfolio. Then you wouldn't, holy heck. You wouldn't want to have more than, let's see, $10,000, $200 or $300. So your spread wouldn't want to be more than like $3 wide or so. Maybe $4, depending on what you collect. So, because remember, you have to subtract the premium. So let's say you have, a $4 wide spread, which is actually $400, but you receive maybe $150 or $1.50 credit for it. So really your risk is, $250, right? $4 spread minus $150 credit is $250. So it's not just the width of the spread, but minus whatever credit you get, right? So, but that's the most risk you should be putting. But that's how to count it. So if you have a $10,000 portfolio, you might have a $4 wide spread, or maybe even a $5 if it's, if you get a lot of credit for it, but nothing more than that. So you just have to take your portfolio size and, take 2 or 3% of that, and that's what you're risking. For a debit strategy, obviously, it's just however much money you pay to open that position. So for, again, a $10,000 portfolio, you're not paying more than $200 or $300 to open a position. Okay? And so that's just one part of it. So, if it gains, obviously it's great. If it loses, it won't hurt too badly. And as I keep saying, it's small, consistent gains. And so, when you do that over and over and over again, it adds up, right? Because you're not just going to have one position on, obviously. Like, let's say you have, let's just take that $10,000 portfolio. Each position might be $300, but you might have 15 of those on at the time, right? And so, let's say you have 15 positions, and with a 70% probability of profit, let's say 11 of those might win, 4 of those might lose. But those losers aren't really going to affect you all that much, and the winners will give you a profit. So it's just, the probabilities, you have to let them play out. And so it's not just looking at one position. You're going to have multiple positions at a time. Very sorry about my throat today.
It's because you had cheese.
I know. Yeah, but I didn't do it till just now, though. All right, so then we want to look at, how much of your portfolio do you want to risk at a time, right? A lot of people want to risk, like, everything they have, all the cash they have available in their portfolio. Maybe plus some if you have margin, right? If you're buying stocks, you might buy more than how much cash you have, right? But for options, at least, so I like to divide my portfolio into options and stocks and cash. But for options, at least, I don't like to risk more than 50% of my portfolio at a time.
Mm-hmm.
So, huh?
You're laughing.
I know, because it's just bad. So, again, if you're looking at 2 or 3% of the time, you might have 15, 16, 17 positions, just depending on how big each one is. Maybe 20 if they're particularly small. But I like to not risk more than 50% at a time. And the reason for that is that a lot of times you need to adjust your positions, you need to roll them out into the future, and you might need cash on the side for doing some of those things, right? So the general advice that I've seen, that I follow myself, is that you don't want to risk more than 50% of your portfolio on options. So if you have a $10,000 portfolio, then not more than $5,000 goes into options, with each one being about $200 or $300. So personally, what I do is I also like to do some stocks. So I might take, maybe 20% or so into stocks. I have a few stock screens that I like to use that work out well for me. And so I will take about 20 to 25% of my portfolio into stocks. I mean, some people would like to do just options, and that's fine, but I like to do some stocks too. But I'd like to keep at least 20% cash.
Yeah.
And so I find that works for me. So you can play around with the numbers and, what works for you. But for me, I like to do, like I said, no more than 50% options, maybe 20, 25%, maybe at the most 30% stocks, and at least 20% cash. And that's how I like to balance my portfolio. So, and, with stocks, I might do some long positions, some short positions. It doesn't really matter. I've been, maybe not lately, but I was trying to hold a few short positions just to kind of balance my portfolio if the market went down. And that worked out pretty well for me, but it just depends. I'm not that great at finding stocks that I think are going to go down. I'm better at finding stocks I think are going to go up.
That makes sense.
So I don't hold too many short positions, but it's just how it is for me. But
everyone has a strength.
Right. But for the options, I think it's definitely important to have not more than 50%. So that is the important thing. So like I said, just take your portfolio size, whatever it is, and don't risk too much at a time. And the other thing I would say is to diversify. You don't want to have all your money into a couple of stocks that are really highly correlated, right? So you might have some into SPY, which is the S&P 500 ETF. But, if you have, let's say, a position in SPY and then a position in the Dow and then a position in the NASDAQ, those are pretty highly correlated, right? You can do that a little bit, but you want to have things like gold or some commodities or oil or gas or, bonds or just totally different stocks from different sectors. So that's another thing to look at. You want to be kind of diversified in that way. Where you're not just in one area of the market. You're kind of in all these different areas and sectors. So that's an important thing. So as for, how many positions to have per stock, the advice I heard is no more than 5% per stock. So you may have, and I do this sometimes, where you may have a stock where you have a 2% position, but it's going really well, so you maybe open up another 2% position or 3% position. But you don't want to have more than 5% per stock. Right? Does that make sense?
I don't know.
All right. So I think we should do and ask Christine, because I don't know where she is. So we're going to... All right. My question to you, Christine, is this. This is fun. If I have... Huh?
For you.
If I have a $100,000 portfolio, I'm taking that number because it's easy.
Okay.
Let's say I have a $100,000 portfolio, and I want to open up an option spread in SPY. What's the maximum amount I should risk on that option? And go.
So, well, I know the percentage, but I can't do it in math.
That's 100,000.
So, it'd be 50, because half, so it'd be 50,000.
So your answer?
Yeah.
So you got the 50. That is from your whole portfolio. Like how much all your positions together adds up to. But each position. Do you remember how much each position is?
Oh, I didn't. Okay.
Yeah.
You weren't really clear.
I was.
That would be 5%.
Well, that's the very most. 2 to 3%.
Yeah, but I can't do that in my head.
I figure it's 100,000. So $2,000 to $3,000.
Okay.
Would be the most that you would do.
I still can't do that in my head.
That's 100,000. 100%, 100,000, 2 to 3%, 2 to 3,000. Oh. I don't know. I chose an easy number.
I know, but I don't know how to do percentages.
That's okay.
Well, at least I got part of it.
Yes.
Sort of.
Yeah. So, that, when I first came across this advice, like, I wasn't a super big fan of it because...
Which advice?
Of small position sizes.
Small positions, yeah.
Because I wanted to win big. And it was like, okay, on a small portfolio, how are you supposed to have, 2 to 3%? Like, that seems so small. And especially when you're selling credit strategies that, you might have to wait a couple weeks to make 50% on your position before closing it.
Yeah.
So, you might open up a credit strategy for, let's just say, like $50, right? And it doesn't seem like that much, especially because for that $50 to actually start to, gain value in your favor, for that credit to start to come into your favor, it might take a week or two. So for one position, you might be looking at gaining $50 over like 2 weeks. Right? Whereas when you're looking at these groups on Facebook and things like that, and people are saying, oh yeah, I gained, $2,000 today, or I gained $10,000 today, or whatever. It's like, okay, so 2 to 3%, and each position is maybe going to gain $50, or again, it depends on your portfolio size, over a period of weeks. It just seems like you're crawling along.
Yeah.
But that's going back to our tortoise and the hare analogy. What was that podcast called?
Slow
and Steady. Yeah, Slow and Steady.
Yeah, is that what it was called?
We didn't call it Wins the Race. We just called it Slow and Steady.
Yeah.
But that's slow and steady because when you have, again, 15, 20 positions in your portfolio, all gaining day by day by day by day by day, hopefully. I mean, some will lose, obviously, but the majority of them gaining, you start to build up a good momentum. Go back to what we talked about Monday with, how quickly you can build momentum, even if you're gaining 30% a year or 50% a year. A lot of people try to way overdo that. They try to double in a matter of months or something, which you just aren't going to do reliably or consistently. But when you have 20 positions on where 70% of them are going to win and, maybe 30% of them are going to lose, and it could be even more than that win. If you do it right, which we'll talk about later in a future podcast, you could have 80, 85, 90% that win. It just depends. But if those positions are gaining day by day by day, it really does add up. Mm-hmm. So I know listening to this, it might be like, oh, that seems really boring, and I want to put everything in and go all into this one stock that I heard about from someone random. And it's supposed to do really well, and it's a sure thing. There are no sure things, right? No matter how tempted you are to throw 50% of your portfolio or 10% or 20% in a single trade, just don't do it, because even if you win several times over, there's going to be that one time you lose, and you're going to lose big because you got overconfident. Right. The market, I saw a quote earlier, and I don't remember where it came from, it was on Twitter, that said, the market has the tendency to tempt us into making bad decisions. And when it does, we're going to pay for it.
Yeah.
You know, so you might win. You see those people who are winning thousands every day or whatever, and that might be you for a couple of times, and then you're going to have that one time where it all goes against you and you lose 30% of your portfolio. You don't want to be that person.
Yeah.
Right? I'd rather gain slowly, and then when I lose, only lose a little bit, than to ride this roller coaster of, you know, up 10%, down 15%, up 15%, you know, whatever, day after day after day, or week after week after week. Just not sustainable.
Yeah.
Right? So small position sizes, 2 or 3%. I know it's not fun. It's not exciting. A lot of this just isn't. It's just numbers. You know, it's just playing it by the numbers, put on 2 or 3%, and if you do that, though, reliably, you will gain consistently, you will gain reliably, and you will outpace those who are trying to take massive risks. Okay? And like I said, if you know, let's say you have that one trade that you think, oh, this is great, I think it's definitely going to go up, I want to buy a call on it, because usually I recommend selling options instead of buying. But, you know, maybe you have that one trade you really think is going to go well. Okay, so if it's super risky, maybe put 1% of your portfolio on that trade. Right? The riskier it is, the less I would put. And I know, again, that's not fun, but it's okay to speculate. Just put 1% or so on that trade, and if it wins, great, you're going to gain. Yep. But if it loses, you're just going to lose 1%. It's just doing it smart. Yeah. You know, take the risks if you want to take risk. Just do it smart. You know,
and it does add up.
It does add up very quickly. Yeah, I mean, this has been a great week for me. I was up Monday and Tuesday. Today, last I looked, it was a little bit up. It's more flat today. But, you know, it really, really does add up. You just have to let it play out. So, and do this slowly. You know, if you're new to options, just open up a couple positions at a time. Even just start with one. I gave a recommendation on Monday for an SPY trade that you can try. It's probably even worth more today than it was Monday because the SPY has been going up. Yeah. But, you know, I got into that trade for 70 cents for the spread. So it's probably worth more today.
Yeah.
But, you know, just try opening up one position. This Friday, we're going to talk about how you select your...
Are we doing it Friday?
Or whenever we do it next. We're going to be talking about how to select your strikes, how to select which, you know, strike to sell. And so we'll be talking about that soon. And so that, you know, you can see whatever stock you choose, how do you select which option you're actually going to sell, right? And that will be a really good one. But just start out with 1 or 2 positions and start small, and you'll see gains. You know, I know options can be super scary, but just don't take a lot of risk, and you'll be fine. So that is what I have for today. So,
wow.
I know, we really saved time today.
Yes, we did.
Even with all my throat issues.
Oh, you're fine.
Of course, now it's getting better.
Of course.
But
because it's almost done.
I know. So, yeah, I think what we will do is, just because I already had one prepared for tomorrow and for...
You mean Friday?
Well, for Friday, yes. And for Monday. So I think what we will do... We don't have anything going on tomorrow, do we?
No.
All right. So,
or we just do it Friday and just do the topic and not worry about the stock part.
Yeah, we could, but it's just like when it's aligned with the market. Like, you know.
Yeah.
As long as you don't mind.
No.
All right, so I will be here tomorrow. And we'll have a topic. Like I said, we're talking about how to choose your short strikes for an option spread. And so instead of Friday, we'll do it tomorrow since the market's actually open tomorrow. We'll sum up the week, do a week in review, and talk about choosing your option strikes. So I think that'll be fun.
Perfect.
So, let me get to our music before I go ending. There. So thanks everyone for listening. I'm glad you could join us today. I hope that this made sense, even though I know it's not super fun, but I think this will really help your trading if you follow it. So we will see you tomorrow, at the end of the week, for the next episode of the Apostle Promise Podcast. Thanks, everyone, and have a wonderful day.
Have a good day. Bye.
Bye.